The following podcast was recorded on Wednesday, August 23rd, 2023, featuring Jim Bianco of Bianco Research. To hear the podcast in real time, you can sign up for a free trial at biancoresearch.com or arborresearch.com, or by emailing Gus Handler directly at gus.handler@arborresearch.com. You can also call Arbor Research and Trading at 1-800-606-1872. Thanks for your time and enjoy the podcast. Welcome everyone to the latest edition of Talking Data. I'm your host, Kristen Radosh with Arbor Research and Trading, joined today by our commentator, Jim Bianco of Bianco Research. Welcome, Jim.
Thanks for having me.
Today, Jim will provide an update on the bank walk. Jim, the amount of funds leaving banks is like nothing we've seen in a long time. How are bank stocks performing?
Well, we have to look at the first chart here, and I'm going to highlight one big stock, and that's Citibank. And this is like the last year or so. And you could see in the middle of March when all the bank stocks dove, and there was the panic around the Silicon Valley Bank failure, and then they recovered into the summer. Citibank is back to that low that it had in March. And you got to go back to October of 2022 to find a time that that bank had been this low in price. So it's back to its panic lows. If we go to the next chart, this one shows you the black line that's going up is the S&P, just for comparison purposes. And the blue line is the Keefe, Bruyette & Woods Bank Stock Index, and the Keefe, Bruyette & Woods Regional Bank Stock Index is in green. Those stocks have been weakening a lot in the last 3 or 4 weeks, and they're back to the levels that they were in the middle of March. Now, they did make lower lows in May, but they're not really recovering. So when it comes to the banks and what's been happening with them, I know that back in March, everybody said, oh, they're oversold. This is a buying opportunity. Maybe it is, but 6 months on, or 4 months, 5 months on, it really hasn't panned out as a buying opportunity. These banks have really been struggling.
So as the bank's walk continues, it's never stopped. What is the latest?
Yeah, so if we take a look at the next chart, as you pointed out, the bank walk, let me define that again for everybody. A bank run is when people panic and they pull their money out of the bank, and then the bank goes insolvent and it's taken over by the FDIC. A bank walk is a slower version of that, where the bank doesn't go insolvent, but is struggling to hold on to deposits, and therefore profitability is really hit. And that's what I think is behind a lot of those bank stocks that have been struggling. It's about profitability. The blue line on this chart shows you that the total deposits in banks, now I indexed it to 0 on the end of 2020, so that you can then see that we have gone up. $2 trillion went into deposits in banks by April of 2022, and most of that has come out. The orange line is the amount of money that has gone into money market mutual funds over the same period. So where's the money leaving banks? The money is leaving banks and it's going to money market funds. $1.2 trillion has gone into money funds over that same period. If you go to the next chart, how unusual is it for banks to lose deposits? Well, this goes back to 2009, and it shows total bank deposits, not indexed to anything now. At its peak, there was about $16.5 trillion in bank deposits. There's $14.77 trillion. So about 9% of the money, the deposits in banks is left. And you can see that as the drawdown chart in the bottom panel. Nothing close to this has ever happened before. So yes, the bank walk continues. It is the bank deposits are at new lows. It hasn't stopped. Money continues to flow into money market funds, treasury bills, anything else that's offering higher yields. Yes, technology, I'm holding up my iPhone. Technology, 120 million people using mobile phone apps makes it very easy to move your money out of a 0 yielding or 1% yielding deposit account to a 5% money market fund. If we go to the next chart, the next chart shows you in blue, the average money market rate in the United States is measured by S&P. It is at 5.28%. The average deposit rate of a bank deposit rate in the United States is 0.5%. The red line on the bottom shows you the spread between the two, It's at 4.7%, 470 basis points, and it's the widest it's ever been. So not only shouldn't the bank walk stop, but there's more incentive now than there's been throughout the entire rate rise cycle for people to leave banks for money funds. So that's why we're continuing to make new lows. And as we continue to make new lows and people leave, again, this is a problem of profitability for banks. Borrowing, getting money from depositors, giving depositors 0.5%, and as a bank, you could go buy a T-bill at 5.25 and pocket the other 475 basis points for yourself. As people leave and banks have to raise their deposit rates or go to money markets and borrow money at 5%, their cost of funding goes up. Their net interest margins are squeezed, and that's why the profitability of bank stocks is such under pressure, which is why bank stocks have been performing poorly.
Where's the bank walk showing up?
Yeah, so that begs the big question. If we go to the next chart, where are we seeing this in the real economy? It has to matter somewhere, right? Well, I would argue you're seeing it in two places. I'll start with this chart here. This chart breaks down the Russell 3000. This is the 3,000 largest companies in the United States, $45 trillion of market cap. Now, the part in red is the FANG plus MMT stocks, or the Magnificent Seven stocks plus Netflix. I like to leave Netflix in there for old time's sake. Those are 11 trillion of the 45 trillion, and the blue is the other 2,993 companies. Now, this is a contribution chart. The black line shows you that the Russell 2000 is up 11.6% year to date. Of that gain, 8.65% of that gain came from those 8 stocks. And the other 2,993 stocks only lifted the index 3%. It's exactly 3% as of yesterday's close. So I would argue that the large number of those large mega caps companies, the Apples, the Amazons, the Teslas, the Nvidias, they don't need banks. They're almost like central banks in and of themselves. They can borrow in the capital markets. They have no problem getting financial services. They're entities onto their own. But when you get to the mere mortal companies, the other 2,993, they need banks. They need financial services. They need money transfer facilities. They need loans. They need a lot of services from banks. This squeeze that we're seeing in banks might be holding back a lot of those other companies, which is why collectively they've only pushed the index up 3%. Not much more than you would have gotten if you've been in money market funds all year, because money market funds are up about 2.6%. The final chart maybe drills this home more directly. The blue line on this chart shows you the spread that banks are offering to their customers over T-bill rates or LIBOR. They used to use LIBOR, now they use T-bill, or maybe they use secured overnight funding or SOFR. And you can see that those rates are going up a lot. The blue line shows that 66% of banks are raising their spread over a risk-free rate that they're offering their customers. The black line is corporate bond spreads. They're going the opposite direction. So the red box on the chart shows you that the spread between what a bank is offering and what you can get in the corporate bond market is the largest ever. And now, again, the Nvidias, the Teslas, the Apples, they could go straight to the corporate bond market and probably borrow at rates very close to what the US government gives. But when you get to those bottom 1,000 or bottom 1,500 companies in the Russell 3000, a lot of those companies, if they need money, they have to borrow from the bank. And the banks are raising their deposit, their rates that they're offering. Why? Because of the bank walk. Now, when a bank is seeing deposit flight, they've got loan to deposit ratios, they've got capital ratios, they've got lots of regulations that they have to adhere to. I understand that the argument is that a bank can create money when it hands out a loan. When you and I go get a loan, like a mortgage, and the bank will give us open us a deposit account and then put that money into the deposit account. It created money. It created money out of thin air right there. Banks are in the business of creating money, but they can't do it into infinity. They need to have certain loan to deposit ratios, capital ratios. They have to adhere to other metrics by the FDIC and the Federal Reserve and the Office of Controller of Currency in order to limit the amount of money that they could create. When deposits are leaving banks at the rate that they're leaving now, it severely impacts their ability to generate or create new money, and that severely impacts their ability to hand out a loan. And that's why I pointed to the other 2,993 companies struggling the way they are. It is not only the banks is the reason that they're struggling, but their conduit for financial services, a bank, is not in the greatest profitability position, and it's showing up with them as well too. So bottom line, the bank walk continues. The bank stocks continue to struggle. The further away you get from your ability to borrow from the corporate bond market, and the more you're reliant on banks, the more your company is struggling too, your stock is struggling, and that's not by coincidence. I think that in essence, those companies that rely on banks are having a harder time than those companies that can be somewhat independent from banks, like a NVIDIA or an Apple. And so it is showing up in the economy. So I do think that the bank walk matters. I don't think the bank walk is going to be something where we're all going to be breathing through paper bags, hyperventilating that the world is ending. It's not going to get to that point. It shouldn't get to that point. But nevertheless, it's just kind of a dull drag that continues. Now, of course, banks have the option to raise deposit rates to hold on to deposits. They kill their profitability. Keep the deposit rates low, and that money becomes very profitable for them. Watch it just continue to walk out the door. They're in a difficult position. Why? The new mobile banking apps, new in the last 10 years, but the Fed held rates at 0 for 9 of those 10 years. So now that they've started to raise rates, we're starting to see that money has a higher velocity, or deposits have a higher velocity. People can pick up their phone, move their money, and it's now starting to show up in banks. And I think it's actually starting to show up in the real economy too.
Jim, thank you for your thoughts today, and thank you everyone for joining us. If you have any questions on Arbor Research, Bianco Research, or Arbor Data Science, you can contact us by emailing Gus Handler at gus.handler@arborresearch.com. Thanks everyone, have a great day.